management, budgeting, saving, and debt elimination, let's talk about the offensive strategy that actually builds wealth over time. This is where most people get stuck because investing feels complicated, risky, and intimidating. But here's the reality: not investing is actually the riskiest financial decision you can make because inflation will slowly destroy the purchasing power of money sitting in savings accounts. Understanding how investments actually work is like learning a new language, except this language can literally change your entire financial future. The problem is that most people think investing is either gambling or something only rich people do, when in reality, investing is simply putting your money to work so you don't have to work forever. Let's start with the basics, because I guarantee your high school didn't cover this. When you invest money, you're essentially buying a piece of something that you expect will be worth more in the future. You might buy shares of companies through stocks, lend money to companies or governments through bonds, or own pieces of real estate through various investment vehicles. The goal is to earn returns that outpace inflation while building wealth over time. The magic happens through something called compound interest, which Albert Einstein allegedly called the eighth wonder of the world. Whether he actually said that or not is debatable, but the concept is absolutely real. Compound interest means you earn returns not just on your original investment, but also on all the returns you've already earned. It starts slowly, but over time it becomes incredibly powerful. Here's a simple example that'll blow your mind. If you invest $100 per month starting at age 25 and earn an average return of 8% annually, by age 65 you'll have over $700,000. But if you wait until age 35 to start investing that same $100 monthly, you'll only have about $300,000 by age 65. That 10-year delay cost you $400,000, even though you only invested $1,200 less in total. This is why time is your most valuable asset when it comes to investing, not the amount of money you start with. A 22-year-old investing $50 per month will likely end up wealthier than someone who starts investing $500 per month at age 40. The early bird doesn't just get the worm, they get the entire worm farm. Now, where should you actually put your investment money? For most people, especially those just starting out, the answer is surprisingly simple. Low-cost index funds that track the total stock market are probably your best bet. These funds own tiny pieces of hundreds or thousands of companies, which spreads out your risk while capturing the overall growth of the economy. The S&P 500, which tracks the 500 largest companies in America, has averaged about 10% annual returns over the past several decades. That includes surviving the Great Depression, World War II, multiple recessions, the dot-com crash, the 2008 financial crisis, and the 2020 pandemic. The stock market goes up and down in the short term, sometimes dramatically, but over long periods it has consistently rewarded patient investors. Here's what most people get wrong about investing. They think they need to pick individual stocks, time the market, or find some secret strategy that beats everyone else. In reality, trying to outsmart the market usually leads to worse results than simply buying a broad index fund and holding it for decades. Even professional fund managers struggle to beat index funds consistently after accounting for their fees. Your investment strategy should be boring, not exciting. Exciting investment strategies are usually code for risky speculation that might make you rich quickly, but will more likely make you poor quickly. Boring strategies like consistently investing in diversified index funds while reinvesting all dividends have created more millionaires than any get-rich-quick scheme ever invented. But let's address the elephant in the room. What about market